Okay, today I would like to introduce the IASB and its 5 standards. First, let's take a look at the framework. IASC was the predecessor of the IASB, so it laid the foundation for the IASB in its article published in 1989. The IASB framework is divided into two parts. The first is the regulatory framework. It includes IFRS Foundation, IASB, ISDS, and guidance on regulatory cooperation and implementation. And the second is conceptual framework. The first is objectives of financial reporting, qualitative characteristics of useful financial information, and elements of financial statements. The last is the reporting entity. So, the ISB framework has lots of benefits, such as guidance for pairs and useful information for users and so on. Okay, the first one is IAS 36 Impairment of Assets, and this is the definition. First of all, we should determine what the asset is, and if it's one of these things, it doesn't apply. We should combine the internal and the external environment to judge whatever there is impairment of assets. And then we should use these 3 ways to determine the recoverable amount. After that, in addition to impairment, if there is an environment control to recognize, we can charge back. However, if these 3 cases occur, IS 36 will be derecognition. The second is IFRS 5, and which is divided into 2 cases: non-current assets held for sale and discontinued operations. And first determine the type of assets, and if it meets the above 3 conditions, it is an non-current assets held for sale. And these 2 steps are conclusions. And if you want to derecognition, you should meet these 3 conditions. And in this part is the definition of discontinued operation, and I give an example to distinguish it from assets held for sale. And assurement of DO or discontinued operation is the same as the non-current assets held for sale, but it should be reported separately. In addition, discontinued operation will terminate if these conditions are derecognition. This is the IAS 21 effects of change in foreign exchange rate, and this is the definition. And it serves 2 cases: foreign currency transaction and overseas operation. And foreign currency transaction have 4 parts, and the overseas operation include both. As for the choice of currency, the The former cannot be decided by oneself, but the latter can be chosen by oneself. When a transaction occurs, it is calculated by spot rate or average rate. Subsequently, the initial entry should be adjusted. Then we should divide non-currencies and currencies. Two cases to confirm. In the transaction's settlement date to return the foreign currency to the local currency again. Through the above process, we find that monetary things have a strong liquidity ability. There will be another conversion, so to confirm the exchange difference and non-monetary item is determined by that. IFRS 15 outlines a five-steps approach for recognizing revenue from contracts with customers. This framework aims to provide an unfilled model, enhancing comparability across entities, industries, and capital markets. The first is identification. The first step involves identifying the contract with the customer and the relative transaction. And second is recognition and measurement. Subsequently, revenue is recognized and measured based on the terms of the contract. And about the determination of obligations, the contract's obligations include the price and the related terms are determined. And about the optionment, revenue is optioned across the performance obligations as they are fulfilled. The family recognition revenue is recognized there at a point in the time or over a point, depending on when control of the goods or service transferred to the customer. IFRS 16 outlines the key aspects of lease accounting. It emphasizes that a lessor surrenders control of an asset to a leased who must manage it within reasonable constraints. Here are the cross points. Recognition. This essence of the lease transactions is recognized, focusing on the lease activities, such as valuable assets such as office buildings, machinery, cars, shops, and incurring obligations like lease payments. Initial measurement, the present value of all accepted payments under the contract, incorporating the discount rate, determine lease liability and usurious assets. And about the subsequent measurement, lease payments and their versions are tracked over the lease term with the discount rate applied consistently. At the end of the lease, the contract may be termed by mutual agreement, leading to the recognition of associated assets and liability. This is the reference list. That's all. Thank you.